Welcome back to Wall Street Podcast. You've tuned in to the Deep Dive, where we cut through the noise and deliver the essential insights from the reports and research you need to know. Today, we're doing a deep dive into the latest APAC conviction list, the Director's Cut July update. This one's fresh off the press from Goldman Sachs, published July 2nd, 2025. Our mission, well, it's to unpack the critical shifts Goldman Sachs is signaling, get into the why behind their top picks, and figure out what it all means for your investment strategy in Asia Pacific. Okay, let's get into it, starting with the big, kind of intriguing addition to Goldman Sachs' APAC conviction list. Goodman Group, what makes them the standout new pick right now?
Right, Goodman Group. Well, what stands out is really their strategic positioning. They're sort of at this intersection of traditional industrial property and the, frankly, explosive growth of digital infrastructure. They're already a recognized leader, owning, developing, managing high-quality industrial assets globally. But it's this pivot into data centers that's really grabbed Goldman's attention. Kane Hannan, the analyst on this, points to four core drivers. First, they've got a highly strategic asset portfolio, plus a really seasoned executive team. And crucially, this team's incentives, strongly aligned with shareholders. They're targeting something like a 6% to 11% compound annual growth rate in earnings per share over the next 4 years.
6 to 11%.
Okay.
And the second driver?
Second, their existing industrial business is, well, it's incredibly well positioned. We're talking growth fueled by global GDP expansion, ongoing rent reversions.
Rent reversions, meaning they can charge more as old leases end.
Exactly. They get to reprice those leases higher. Yeah. Plus, you had the widely anticipated interest rate cuts helping things along.
Right. Now, this digital infrastructure play, you said that's where it gets really compelling. It feels more aggressive than just dabbling. How significant is this shift? What's the potential impact here?
Oh, it's definitely aggressive. This pivot into data center development is potentially a game changer for Goodman. They really beefed up their war chest with that massive $84.0 billion raising back in February. That was specifically for this. And their 5.0 gigawatt power bank, it's not just marketing speak. It's a serious strategic asset. It positions them for substantial development and, importantly, those recurring fee-based earnings.
5 gigawatts, that sounds like a huge amount of capacity.
It is. And the market opportunity here is enormous. We're seeing strong industry feedback on their sites, their team's quality, plus this backdrop of the global AI and cloud boom. Goldman Sachs global team, they're forecasting an astonishing 28% compound annual growth rate for AI-related data center demand. That's from 2024 right through 2030.
28% CAGR. Wow. That changes the definition of prime real estate, doesn't it?
It really does. It shifts it away from maybe traditional retail and offices towards these, power-hungry tech hubs.
So demand is there. But what makes Goodman uniquely capable? We hear about the challenges, getting power, approvals.
That's a critical point. Goodman seems remarkably well-placed to tackle those common hurdles. Securing enough power, navigating complex site approvals, these are big deals. They're leveraging decades of development experience. That's a huge advantage in a sector like this, which is very capital-intensive and, frankly, needs a lot of permissions.
Okay. And the valuation, Goldman sees an opportunity there.
Yes. While disclosures are still a bit limited, Goldman Sachs estimates Goodman's equity share of that 5.0 gigawatt power bank could be worth a staggering $33 billion. Compare that to the, say, $27 billion implied by Goodman's current share price. It suggests roughly a 20% discount in how the market's valuing their data center potential right now. That's a significant gap.
A potential 20% mispricing. Okay. So the data center story is exciting, definitely. But what about their bread and butter, the traditional industrial business? Is that still solid?
Oh, absolutely. Kane Hannan is still very positive on the core industrial side. It keeps benefiting from global GDP growth, a healthy return to growth in e-commerce, post-COVID, that sort of thing. And there's still increasing demand for these high-quality, large-scale automated warehouses. Their earnings, their assets under management, or AUM, should get a boost from those expected interest rate declines, too. Goldman's looking at about 70 basis points, FUM weighted, by the end of 26. Plus, remember those rent reversions. As of Q3 25, about 16% of their properties were under earning market rates. So future releasing adds to the bottom line.
Right, embedded growth there.
Exactly. Goldman actually forecasts their AUM to grow at 7% per annum through fiscal 28. So the core business is still very much a driver.
Okay, so for investors watching Goodman Group now, what are the immediate catalysts, the things that could, prove out Goldman's conviction?
Yeah, two key near-term things to watch. First, their FY25 results coming up August 21st.
Yeah.
Goldman expects them to guide for FY26 EPS growth of at least 10%. Second, keep an eye out for an anticipated data center development joint venture that's expected sometime in calendar year 2025.
And Goldman's price target reflects this bullishness.
It does. Their 12-month target price is $39. That's based on 24 times their estimated FY27 EV/EBITDA, which lines up pretty well with global data center peers.
$39. Okay. So Goodman Group is clearly making waves, but let's zoom out a bit. Goodman is in, but some others are out. Panasonic, Anhui Conch, Iluka, NextDC. What does this shuffling tell us about Goldman's broader view? The market shifts.
Right, the removals. It's really important to understand that being added or removed from this list isn't like a formal stock rating change. It's not an upgrade or downgrade per se. It just signifies that Goldman's subcommittee either, no longer has that highest level of conviction in that specific stock. Maybe the price ran up significantly or the catalysts they were watching have played out.
Or they just see better ideas elsewhere.
Exactly. They've simply identified better, maybe higher conviction opportunities elsewhere in their APAC coverage. It's a dynamic list, meant to reflect their absolute top ideas at that moment.
Got it. Now, this report isn't just about stock picks. It also gives us a window into Goldman's wider global and regional views. That's just as crucial. Let's unpack some of those key strategic takeaways, starting with the big macro picture.
Absolutely. Connecting the dots here. In their global macro views, Goldman has actually nudged up its U.S. growth forecast a bit, and they've pulled forward the timing for the next Fed rate cut. Now they see it happening in September. They expect 3 25 basis point cuts by December 2025, and then 2 more in 2026. This reflects a pretty significant decline in perceived recession risk. They peg it at just 30% now.
Lower recession risk, earlier cuts in the U.S. That sounds positive for risk assets generally.
Generally, yes. The report also notes a weakening U.S. dollar, which is usually helpful for emerging markets. And interestingly, it points to an unbalanced Chinese economy. Exports are holding up, resilient, but domestic demand still sluggish.
Unbalanced China. Okay. So how does this optimistic U.S. view translate specifically to Asia? You mentioned it's not a uniform story.
Right. They really emphasize idiosyncrasy in Asia, meaning different markets are doing different things. They've actually raised Korea to overweight.
Oh, interesting. Why Korea?
Because of positive market-specific developments there. They've set a KOSPI target of 3,100 and are forecasting strong 16% earnings growth for 2025 in Korea. Taiwan also gets an upgrade, back to market weight after underperforming. And to fund these moves, they've lowered Singapore and Indonesia slightly in their rankings.
And sector-wise?
Regionally, tech hardware and semiconductors got an upgrade. That fits with the AI and data center themes we've been discussing.
Okay, now maybe one of the most intriguing parts of the report. The comeback of Chinese POEs, private-owned enterprises, after losing, trillions in market cap. What's driving this narrative?
Yeah, that's a fascinating section. After that staggering US $4 trillion market cap loss, these Chinese POEs are genuinely regaining momentum. Goldman lays out some clear arguments. First, there's been explicit policy recognition of the private sector's vital role. Regulations seem to have eased. Second, AI and tech breakthroughs are brightening their prospects. And critically, these POEs are the ones leading China's going global ambition. You can see it in the numbers too. Their profits and ROE have recovered significantly since the lows of 2022.
And they highlight specific companies.
They do. They talk about a prominent 10, including giants you'd recognize like Tencent, Alibaba, Xiaomi, BYD. These are seen as potential market dominators. And importantly, they're not just any companies. They embody China's key strategic themes: AI, tech development, self-sufficiency, and improving shareholder returns as they expand globally.
That is a compelling turnaround story. But the report also talks about China in transition, right? And this persistent issue of overcapacity in areas like EVs and solar. How do those two things fit together? The POE comeback and the overcapacity problem.
That's the tension, exactly. Despite stimulus efforts, the report indicates that overcapacity across key manufacturing sectors, well, it largely remains unchanged. This suggests what they call a delayed trough inflection. Basically, the bottom of that industrial cycle might still be getting pushed out. There's potential negative cyclical risk ahead.
So the recovery depends on stimulus effectiveness and domestic demand picking up.
Pretty much. It depends on how quickly and effectively those stimulus measures work through the system, and crucially, if domestic demand can really start pulling its weight. So yeah, it's a bit of a mixed picture. POEs showing definite strength, but broader industrial challenges are still there.
Okay. Let's circle back finally to APAC data centers, but maybe through that broader lens the report uses. It conceptualizes AI's impact on real estate. How do they frame this shift beyond just Goodman?
Right, this section draws a really powerful parallel. Think about the e-commerce boom and what it did for logistics real estate. Goldman sees AI doing something similar, but maybe even bigger. For data centers, they project data center demand growth driven by cloud and AI at a massive 60% by 2027. That growth rate vastly outstrips what we saw even during the peak logistics boom.
60% by 2027.
Yeah, it signals a truly seismic reallocation of capital within the real estate sector. They consider the sector very early in its cycle, expecting vacancy rates to stay low, below historical averages, until at least Q1 2028. And here's the kicker. The report suggests the sector might be mispriced. Trading at an average of 20 times one-year forward EV/EBITDA seems potentially low given the growth outlook. There could be significant upside.
And Goodman is explicitly mentioned as benefiting.
Explicitly mentioned as an impacted stock, yes. Perfectly positioned to capitalize on this trend.
Okay, so putting it all together, this report connects a lot of dots. Data centers, AI, global rates, China's balancing act. It definitely raises some important questions for you, the informed investor navigating these shifts.
Indeed. There's a lot to consider.
Let's dive into our first question then. Given this heavy emphasis on data centers and AI across the report, just how significant is this shift for real estate investment overall? And what should discerning investors watch for, maybe beyond just a single company like Goodman?
That 60% demand growth forecast. It's not just a signal for one sector. It really underscores a fundamental, probably long-term reallocation of capital within real estate. This isn't just about square footage anymore. It's about highly specialized infrastructure. It needs huge amounts of power, intricate approvals. So for investors, beyond looking at individual companies, you really need to watch regional power grid capacity.
Power availability is key.
Absolutely. And the regulatory frameworks, do they streamline development or hinder it? Also, watch for new players or partnerships emerging who can actually navigate these complexities. That early in the cycle observation, it suggests significant untapped potential, especially for those who can figure out where these critical bottlenecks like power and approvals are being successfully overcome.
Right. Makes sense. Okay, second question for you. The report highlights these forthcoming Fed rate cuts in the U.S., plus ongoing easing in Europe. How might these synchronized global monetary shifts influence APAC markets, especially thinking about that unbalanced Chinese economy Goldman mentioned?
Yeah, that's a great question about interconnectedness. Generally, global monetary easing tends to boost risk appetite, right? And it reduces the cost of capital. That can be a nice tailwind for equity markets across APAC. Now, for China specifically, while exports are holding up, that sluggish domestic demand is a concern. Lower global rates could indirectly help Chinese companies, maybe especially those going global POEs we talked about, by making international expansion and financing potentially more attractive, cheaper. However, that unbalanced label is important. It implies that while these external factors might provide some support, a full recovery in China really needs more. Getting domestic consumption firing again, sorting out internal market dynamics, that'll likely require continued targeted policy intervention that goes beyond just tweaking interest rates to really rebalance things.
Okay, so global easing helps, but doesn't solve China's internal issues alone.
Got it. For our final point, that comeback of Chinese POEs narrative. It's compelling, especially with those prominent 10 companies. What's the core differentiator for these 10? And thinking about past regulatory swings in China, how sustainable is this renewed mojo? Is there risk of the pendulum swinging back? What's fascinating, I think, is that the prominent 10 aren't just any POEs. They specifically embody these key strategic themes for China AI and tech development, self-sufficiency, leading that going global push, catering to new forms of consumption. Their differentiator is really their alignment with these national priorities. That, coupled with proven profitability and a track record of innovation, the report suggests policymakers have recognized the private sector's role and the regulatory climate has eased quite significantly.
But is that easing permanent?
Well, the sustainability of this mojo, as you put it, really hinges on continued explicit policy support for their strategic direction. That's key. And of course, on these companies' own ability to execute leveraging AI, expanding globally, maintaining their edge. It can't just be about a cyclical market recovery. If that clear policy support starts to waver for some reason, then yes, the risk of another pendulum swing definitely increases. Alignment with policy seems critical here.
Continued policy support is the linchpin. Okay. That's a wrap on this deep dive into Goldman Sachs' latest APAC conviction list. From Goodman Group's big strategic pivot into digital infrastructure, really illustrating that massive capital reallocation to the broader shifts in global monetary policy, and that intriguing comeback story of Chinese POEs. There's certainly a lot to digest. We hope this deep dive has given you a useful shortcut to being well informed, hopefully with some surprising facts and critical insights that, help cut through the noise out there. As you consider all these dynamics, maybe think about this. Beyond the direct financial implications we discussed, what broader societal shifts, maybe subtle ones, could be signaling the next major investment conviction theme for the APAC region? Something to keep exploring. Until next time.